Hello, this is John Kvale, and this is our September monthly review. And longtime followers know I have been fighting this relatively new video camera because it fades and it forces me to sit so still. I feel like I'm very uncomfortable, and I ordered another one 2 weeks ago, and it still hasn't shown up. So I'm going to do this last. This may be the last, hopefully the last one, with this video camera, and it's supposed to be in tomorrow, although it has said that for the past week, the new one. So I'm doing the monthly and saving the newsletter video for hopefully the new camera. I just got a big kick out of this. Those of you that are in listen only mode, I have the AI generated Federal Reserve person with a pot of porridge, not too hot, not too cold. I keep wanting to say Little Red Riding Hood, it's Goldilocks, but anyway, I'm almost a minute into this, and I am already burning up some time. So we will move on. Those of you in listen-only mode, we do this in a audio-video podcast type of format, a short podcast. Podcasts are generally longer, but to granularize some of the things that I'm talking about. So if you're driving down the road, listen to this, keep your hands on the wheel and don't wreck. I always say that. I think it's funny, and I guess it'll be my tagline. Financial planning tips, we have two. I just added one. This is Sunday before this will be post. Number one, let's check our run rates on our 401k. I actually had a typo in that. The IRS released multiple things at once, and I looked at my cheat sheet and misread it. It's actually $30,500 for catch-ups, including those that are age 50 and above. It's $23,000 as your regular filing if you're below 50. So $23,000 for most employers. And then what I highlight here is that the catch-ups are usually where the problems are. So literally had two conversations this last week of folks saying, well, wait, it stopped at 23 and it needs to go higher, and that's because their employers had didn't have the catch-up provision set up. So double check that. It's just a gentle reminder. Another gentle reminder is required minimum distributions. We're going to start those early, so to beat the end of the year rush. Hopefully to have most of them done by October. For those of you that are not on monthly RMDs, we also are. I've coined this. This is kind of funny. Distributions for some non-mandatory RMDs. That the general gist of that is just to even out. This is a chart by Michael Kitces. I've used it before. Is to even out the cash flows rather than wait until the way back when the theory was do not take your IRAs until the very end. Well, what that can do is trigger higher tax brackets, and so you're trying to even those out. So we'll be doing a lot of that at the end of the year. Moving on to the capital market comments. Newbies, we do this. We usually do we always do a financial planning. Hopefully something that you get out of this, a reminder, a note, and then we talk about the capital markets. So 3 posts combined here. We had a weak unemployment number and the capital markets UnInverted. I posted this kind of quick, trying to get a jump on everybody, all the other mainstream media. It's stuck. We did stay uninverted. So early in September, we uninverted. This is 10-year and the 2-year, finally going back to normal. Then, when the Federal Reserve came in, I called this the porridge, which I had to check how to spell porridge, the porridge post, back to our Goldilocks and Little Riding Hood. The Fed was pretty much expected 25 basis points. They did 50. Market the first day just kind of, not that we watch it second by second, but minute by minute. A lot of people were positioned wrong. They cheered it later, but what happened is it went ahead and uninverted even greater. It's a little bit hard to see on this, but I mentioned this in my first post, which is called the Pro Tip Reminder, that when the Fed lowers rates, it doesn't always mean that long-term rates, most normal 30-year mortgage rates will immediately come down. They're not directly related, they're indirectly related. That's what's actually happening. We've seen the 10-year rate actually go up. The 10-year is purple here, by the way. So we'll keep an eye on this. We won't pester you with it, but it is important, and we want to follow it and give you a heads up on what's going on. That is the shortened post with my frozen head, so that this silly video will not, and it still does it, tries to focus. I'll go back here and give you one last view on this funny, that was an AI picture that I said a Federal Reserve official eating porridge, and that's what it gave me. Kind of funny. So I don't know what this outfit is, but anyway, thanks for your time. Hopefully I'll get the camera by Wednesday so we can do the newsletter. You probably, those of you that get paper newsletters, which is everybody that is clients and friends and family, you probably already have that, and I usually try and do the post sooner, but I want to get a good camera. All right, have a good day. Thank you so much, and that is your September.
On 5.